Good morning, everyone. Thanks for joining us for Credit Clear's Q4 24 quarterly investor presentation. The deck, as well as the quarterly activity report and 4C, have been released to the ASX this morning, so those documents are available online. We'll be running a Q&A at the end of the session. Please just raise your hand or submit the question in writing. When you raise your hands, we'll unmute you and let you pose the question. The session will be recording. We'll be sending a recording around later this afternoon. But with that done, over to Andrew Smith.
Thanks, Warwick. And just wanted to welcome Victor Peplow, our CFO, and Jason Serafino, our Chief Product and Technology Officer. I think the headline says it all, record profit, record revenue, and record cash generation. So we're extremely proud to have reached and exceeded each of our guidance. So to have increased our guidance 3 times in the last 6 months and overachieved on each of the promises that we've made makes us very, very proud. And it really coincides with some advice that I received 2 years ago when I took the job as CEO, which is consistently over-deliver on your promises. So, thanks to the guys at Thorney and JN Financial, the little group, and Centennial, who all, gave me that advice. And, to sit here 2 years later on the back of not just a strong Q4 in 2024, but an incredibly strong year across the 2024 year. So a lot of people to thank in terms of, my senior executive team, but really led by the new Chief Sales Officer, Eddie Smith, who was recently appointed the Chief Sales Officer, has driven a lot of that organic growth through signing really tier one, clients across banking and finance, utilities, insurance, which has not only delivered a fantastic 2024 financial year, but set us up for a cracker of a 2025 financial year as well. So let's get into the details. So there might be a few new faces on the call. Certainly for those who've been on these for the last couple of years, I might be repeating myself, but it's been fantastic to see some additional coverage on the business. I think clearly the market is understanding that this is a legitimate business, delivering consistent growth in all areas, and is a genuine prospect for future investment. So we're an ASX-listed company driven by an artificial intelligence technology platform that underpins our servicing business, Armour Group. That Armour Group delivers recovery services across a wide range of industries across banking and finance, utilities, technology, and business to business, and as well as government. We've got an enormous total addressable market across this, current Australian and New Zealand market that we play in against traditional collections businesses, as well as really fintech technology businesses. And we consistently deliver a better service, not in terms of just recovery rates across groups, but also in terms of the customer experience for those who are experiencing the challenges of paying their bills. So we've got a really, really strong end-to-end service offering with Credit Clear, the technology platform, Armour Group as the service delivery arm of the business, and then Oakbridge Lawyers, who are the late-stage part of the business as well. So, market conditions are favourable to us as well. So what we would see is future prospects of growth to continue. So whilst this is usually Victor who talks about all the financials, I couldn't let him take all the limelight here. I'm going to talk predominantly about the revenue growth over the last couple of years. And as you can see on the graph on the left, we've taken it from, $8.9, $8.4 million quarters all the way to our first $11 million quarter, booking $11.5 million in Q4, which is, once again, just something we're all incredibly proud of. And, quite frankly, being a 28% increase on prior corresponding period and 10% quarter on quarter is something that we are extremely pleased with in terms of how the business has performed, but also in terms of how it's positioned leading into FY25. So I'll throw to Victor now that sort of can talk a little bit more in terms of how it drops through in terms of underlying EBITDA, what cash we're generating now from activities, and how we can invest some of that money that we've now got in the bank.
Thanks, Andrew. Look, excellent set of numbers we've got here on the slide, with record numbers being achieved in revenue, cash flow from operations, as well as underlying EBITDA, for which we upgraded our guidance yet again this morning to $4 million for the year. And again, I think that increase or consistent increase in underlying EBITDA demonstrates, hopefully, to the market that the business model is working, and it's working effectively. It's converting to producing excellent financial results. Not only is revenue growing, which it has been consistently, as you can see with the graph to the bottom left, we are now getting strong flow through to the bottom line. In short, we are achieving operating leverage, which is what a lot of the fund managers and investors have been looking for. And I think we've demonstrated that over the last 12 months. Focusing a little bit more on revenue, obviously strong growth there, as Andrew's pointed out, 28% PCP. We are very pleased with. And it's important to know we're not only seeing revenue growth from existing clients who continue to increase their share of wallet with us. We are getting strong sales, and we're starting to be noticed in the market as a serious player. And what doesn't come through in the graph there is the quality of clients coming through. We are picking up some big names, which, although take longer to onboard, and there are very detailed DD processes you need to go to. Once they're on board, the level of revenue is much higher, and what's more, the integration between client systems and our systems makes for much stickier business. So that's the difference in what we've seen in the business through FY24 relative to prior years. And I think that's a sign of our maturity and development, and the quality of collections and the digital piece, which Jason will talk about, that we've really communicated to the market. So that's revenue. All that is flowing through the strong cash from operations, as you can see there, with a strong green graph. And again, that increase in revenue on a quarterly basis, combined with a disciplined approach to expense management, is giving us that underlying EBITDA number, which continues to improve. And when we release our annual result, you'll really see that coming through when we compare year on year, because it can get lost a little bit in quarterly and half-yearly numbers, but you'll see that really shining year on year. And with all that, that'll leave us with $13.1 million in the bank for the year end, which gives us ample flexibility to explore opportunities that we're currently seeing in the market. So all in all, very strong quarter. We're looking forward to communicating a strong annual result as well. But we are very pleased with the way the financials are progressing at the moment. So that's that slide. I'll pass back to Andrew now.
Just continuing on that side a little bit. I did have that point, same as Victor, to say, look, Credit Clear has really established ourselves as a tier one provider of credit and collection services. And we've got a case study on ANZ a little bit later that talks about how we perform for them. As you know, once you're starting to doing work for major banks, utilities, telcos, it doesn't take too long for the others to see just how well you're doing and following suit. So once again, a big shout out to the sales team, led by Eddie Smith, that have done an incredible job in terms of signing new clients, a lot of which we haven't seen $1 revenue for in 2024. So I keep on talking about how well we're positioned for 2025. I'm saying that because we've gone through that process of investing in sales and marketing, onboarding to win these key clients. And it's about, delivering now. So, some very, very good numbers to sit behind. And for those who have been, patient and have been long-term investors, I'm really, really pleased to be delivering results that, show that your faith has been rewarded. So let's little look at the leading indicators. These are something that we've shared in the past. And whilst the total amount of debt under management being $2.3 billion is fairly steady, as is the number of active files that are under management, what we're seeing is an increase in terms of the recency of those files. And what I mean by that is that we've closed off a lot of those pre-COVID accounts that we've been sitting and hanging on to. So our active number of files has gone down in terms of closing files off, and a lot of the new work's come into the business. So that's where we're going to drive a greater return from active files. Is the fresher they are, the more recent the work's been referred, is actually where you derive the most value from the work. So whilst those two graphs do look flat, if you look further into the numbers, if we give you some more data in future presentations that look at the recency of the work that we've been referred, what you'll see is there's far more recent active files that have been sent across to us. Once again, 89 new clients, signed over the period of the last 3 months, which once again continues our strong acquisition of new clients. 70% tender win rate is really encouraging. That tier one providers are looking for innovation and looking for a solution that manages customer vulnerability in a more empathetic, frictionless way. And those advantages that we're seeing that Credit Clear, Armour Group, and Oakbridge delivering is what's really delivering that high tender success rate. So and we see that to continue as well. So really pleased with the number of new sales and the active inventory that we've got to derive future value. Couple of key new tier one clients have come into effect in the last quarter. A couple of years ago, we'd be happy to win one tier one client in a year, let alone two in a quarter. So it just talks to the acceleration of our business in terms of that move into a tier one provider. So 2 tier one clients, very pleased with that. 45% of our revenue are coming from tier one clients. So it's a very good spread across the business, having 20 tier one clients. And as Victor alluded to earlier, those tier one clients have a very long onboarding process. It creates real stickiness between the client and the supplier in sort of Credit Clear and Armour Group. So therefore, once you're in and you continue to do a good job, likelihood is you just get more work. So very encouraging, not only in terms of tier one clients, but in terms of tier two clients increasing as well. So I won't go too much into more detail there, but still very encouraging improvements. Straight to Jason. He can talk more about the digital transformation and the software as a service platform.
Thanks a lot, Andrew. So another key lead indicator we've been reporting since inception for digital is payments on the digital platform, which you can see here. So these are self-service payments where a customer has received SMS, email, WhatsApp messages from us, clicks on them, comes into our portal on their phone and makes a payment or sets up a payment schedule that will automatically process. So in other words, these didn't require any human touch. And as you can see, we continue to show really strong progress. Payments growing 65% against the same quarter last year to 33 million. And for context, as you saw, group revenue grew 28% over that period. So we've seen a very strong continuing shift to digital, particularly in our consumer portfolio, where you have high volume, low value debts really well suited to digital. We've seen a real doubling of the proportion of payments made digitally over the 12 months in consumer. So why do we care about digital payments, and why should you as an investor care about it? And there's two big reasons. One, profit, and the other is sales. So in terms of profit, digital is high margin collections, 80 to 90% gross profit. Compared to collections with operators on the phones, that's expensive. You might be close to 50% or so. So the higher proportion of digital is one of the best lead indicators to increasing profitability. One of the reasons why you've seen that playing out so well this year and we hope to see that continue into next. As we continue to bring on new clients and grow our collections, we can do that without putting on headcount proportionally, in part because of the increasing use of digital. The second Andrew mentioned as well is sales. We've seen clients increasingly ask for digital capabilities in tenders. They really love to see the combination of the best people with the best technology, and that's winning tenders, as Andrew said. ARMA's seen tender win rate grow from 30% pre-acquisition to 70% now, in part because the clients are really demanding digital. Over to the next screen, Warwick. So one of the areas we're very bullish about, and certainly since I joined 5 years ago, we've had a big focus on, is AI and its potential in the collection space, particularly as the industry digitizes more of its activities, which then opens the door for AI. We all know we're in a bit of a hype cycle at the moment with AI solving anything, but we've always taken a very pragmatic, scientific approach to all our technology investments in the platform, where we measure the results. And it's easy for us to measure success because, does it collect more? Do we see more money in the bank? And that's what we keep an eye on as we are rolling out new changes. And we do it through champion challenger testing. So just like if we're testing a new medicine or a new drug, they'll take a group of customers, split them randomly between a control group and a test group, where the control group gets a placebo and the test group gets the new drug, and they can tell whether it's working. We do the same thing. So we take customers and we randomly assign them to 2 different collection strategies. In this case, we were testing an upgrade to our AI, and we conducted a test with a large energy utility. One half of the customers was our control group, and they got our platform with our digital messages and our self-service portal, but in a predictable program sequence of messages. The other group got our AI, where our AI is deciding the action to take each day, which has been trained on tens of millions of customers previously. And it makes the decision about whether to send SMS or email, what time to send the message, etc. And as you can see, the results are really pleasing. We saw the AI group deliver 22% more collections over that test period. So very exciting, very happy client. We then take that result and we speak to our other clients and we offer them the same update in our next regular meeting with them. And this service, a continuous optimization, is a real differentiator for us as an organization and for the platform.
Yeah, no, I think that it's pretty clear when people start to talk about what our secret sauce is, what our moat is. It's really that sort of technology piece that, can deliver those uplifts. You can't just, magically, generate tens of millions of experiences to draw upon a technology that's going to replicate what Credit Clear provides. So, it is that really gives us that unique advantage. Once again, supported by the great service and the great people we've got. But they're the things that really set us aside from our competition.
Yes, it really is a wonderful place to be as a data scientist with such high volumes to be able to work with. So another exciting development, one I'm very excited about, and it's a bit of a pet project of Andrew, so I know he'll talk to this as well, is the release of our new digital hardship solution called iAssist. Now, when we talk about hardship, it's easy to maybe mistake it as a bit of a niche problem. Historically, that was true. A very small proportion of customers officially declared hardship 10 years ago. And the hardship process in most organizations, it probably dates back that far. It's probably 20 years old. And commonly, it's quite a horribly complex process to ask for hardship, filling out a statement of financial position, all your income, expenses, assets, liabilities. And most people, and certainly people who are financially stressed, couldn't get through that process. But there wasn't historically a big motivation to fix this in organizations. But the world has really changed. And particularly when COVID hit, so many people were impacted, many of us for the first time. And a huge proportion of people were then calling out to their suppliers, their banks, their energy companies, and asking for some support and flexibility. And these companies and their platforms are simply not designed to deal with this. But the community and the regulators really demanding change. So we've seen huge fines, and there are very strict timeframes to adhere to if a customer mentions hardship or requires flexibility. And many organizations are dealing with this old platform, spreadsheets and email, and it really is a problem waiting to happen. So we've got lots of experience in this space we can help with. So digital engagement, self-service portals, flexible payment plans, really our area of expertise. And so we've built on our prior platform a new bolt-on module on our SaaS platform that clients can use to manage the hardship process. You can see a couple of the screens here. It allows a customer to very easily submit key details about their situation. And we can track and manage that from that inception all the way through to a compliant outcome, ensure that our clients remain compliant. But also a high proportion of customers just need a little bit of flexibility. So they need a payment plan, maybe an extended time frame on it in order to be able to resolve the debt. So if the customer goes through the forms and then they fit the rules that we're setting for that particular client for a complete self-service solution, they can then just go straight on and set up a payment plan on the self-service portal if they want to avoid an embarrassing phone call. We'll see, but I anticipate a very high proportion of customers will be serviced that way. And then that leaves the hardship team in our organization or in our clients' organizations to focus on the people who need or want the human contact.
Yeah, look, we've engaged not just community leaders in terms of, financial counsellors. We've spoken to major clients that we work with in the utilities, banking and finance space. They've been calling out for this type of solution. It's extremely manual to manage financial hardship requests, which is effectively anyone who can not afford a bill when it falls due. So this is, you think about inflation and cost of living. This has been a growing problem over the last 18 months and even earlier. So what we've seen is a huge amount of interest from clients, a huge amount of support from industry leading groups, and certainly strong endorsement from those experiencing financial hardship that we've consulted in the development of this product. So, I know Jason alluded to it earlier. This is something that's very important to me and the overall business, is that not only do we sort of focus on, collecting, money on behalf of our clients, but also managing these type of challenges, which have become much bigger, certainly over the last 18 months as those interest rates increased and inflation continued to be high. So watch this space, for additional revenue growth. ANZ, we got the green light from them to publicly share their logo and name. So it's the first of the big four banks that we've been able to do that for. And it actually is a fantastic case study for us to really showcase how, the group is able to, first of all, win a competitive tender for a piece of work with, a big four bank, to onboard and go through the due diligence period for, I think it was close to 9 months. And then we've just completed the 3 months of our trial period. So let's flick through to the next slide, slide 12, and I might go backwards and forwards. So where we're at today with ANZ is that we've just finished the 3 months worth of, initial portfolio of debt optimization, and we have absolutely shot the lights out in terms of performance. So we were the leading service provider by almost 50% in terms of recovery rates, and every single other metric in terms of service compliance, we were leading the panel as well. So what that's resulted in is an increase of work, not just in the portfolio we're working on, but 2 additional portfolios. So if you look at sort of the third graph, along, it's showing optimization and increase of share of work. So we're seeing, ANZ, which up to this point, and probably even a little bit further has been, costs from our side invested into it. The outlook in terms of ANZ looks very, very good. Not only that, is the case study data that we can pull from this type of work can only strengthen our case for doing work with, other major financial institutions, whether it be in Australia or internationally. So very, very, very pleased with, how the team has executed on that, not only from a technology perspective, but from a people perspective. Okay, so let's look forward in terms of 2025. Trading conditions continue to be supportive. I know that sort of there's, real challenges around keeping inflation or trying to get inflation down. Interest rates are probably stubbornly going to remain high, perhaps for longer than we'd hoped. Australian companies are strengthening their debt resolution capabilities. There's pressure in terms of insolvency rates increasing. So, this environment in terms of macroeconomic tailwinds is certainly in our favour. And, Credit Clear being a defensive type of investment for a lot of you shareholders out there should feel very positive about that. Organic growth, once again, over the last 12 months has been exceptional. We've been super, super impressed with the sales team in terms of their commitment to growing not only our number of new logos, but in terms of diversifying the work we do for existing customers. So we're very, very, very pleased with that. We've signed partnerships with really large software providers to integrate our Credit Clear SaaS technology and offer it to their clients. So that's going to give us a real accelerated growth for next year and open up new markets for us, potentially overseas. So once again, very exciting. And just strong new business pipeline moving forward. I talked earlier about the fact that we've signed lots of customers or in a sales process with lots of customers that we won't have seen $1 of revenue for in 2024, which sets us up for a very strong financial year in 2025 and beyond. So look forward from a guidance perspective. Those analysts will start to do the numbers and start to look at where we could get in 2025. But in terms of 2024, to have exceeded the guidance of $42 million in terms of revenue is very, very a good result. But what's been exceptional in terms of the underlying EBITDA or drop through in terms of extra growth has been to have increased our guidance once again to $4 million in terms of underlying EBITDA. So, to have increased our guidance 3 times in the last 6 months has got to be the highlight for the year from my perspective. So, a successful 2024, all in all. Once again, to have been able to sit here with the senior executive team and to have overachieved on our promises, it makes this presentation, really a pleasure. So, look forward to getting correct questions, from the audience, and I'll flick it to Warwick now.
Thanks very much. We have a question from James. James, you should be unmuted and can pose your question.
Can you hear me okay?
Yes.
We can.
Yeah, cool. James Nicolau from PAC Partners. Andrew, Victor, Jason and Warwick, congratulations on a great result. Just wanted to ask 2 quick things if possible. Just in terms of the cadence of new contract wins over the last 12 months and the sheer volume that you're seeing and wins on that front, should we expect that as sort of being able to be replicated going forward, or do you see that sort of increasing, decreasing? Can you just talk a bit more about how that's shaping up? And then I've got another one after that, if that's okay.
Well, good question. We've just continued to invest in our sales and marketing. So the sales team has grown. The investment in terms of marketing has grown. So we would expect a return on investment from that, at least to maintain that level of new client acquisition moving forward. So we've shied away from, I guess, other fintechs who have really reduced their investment in terms of technology or sales and marketing. We've gone the other way. So we believe that we've got this opportunity to take advantage of the place that we're in terms of our market advantage and continue our aggressive sales approach. So one, absolutely look forward to continuing that sales growth for sure. What was the second part of the question, James?
Just in terms of, is this the new norm, or is there a potential for this cadence of contract wins to by volume and also number continue to grow at this rate?
Absolutely.
Cool. And as a segue to that, given the ANZ case study and the amount of work that's gone into to onboard that client in particular, as a part of all the other tier ones, what are the key learnings that you've taken from that process that could potentially might speed up any future clients that are of that size?
Look, another absolute great question. You know, the onboarding from an ANZ perspective was the most robust technical that we've ever been through, as you'd expect. I mean, even the government clients that we've worked with haven't been as, you know, intense. So all the policies, procedures, systems, processes that we've actually had to put in place for ANZ, and now they're ready to go in terms of being able to deploy to other organisations. So just an example, you know, there's a third party that ANZ used to integrate with a third party like us. We've now integrated with that organisation. Now they operate not just in Australia, but they operate in the UK. I've just come back from a trip to the UK where I've met that organisation, and our integration that was effectively sponsored by ANZ has given us the opportunity to actually just integrate and be rolled out to other providers, not just in Australia, but internationally.
Fantastic. Thanks again. Well done.
Thank you.
Thanks, James. Larry, over to you.
Thanks, guys. Excellent result, team. It was really well above expectations there. Look, I just wanted to ask you, I see you called out councils, and the 90% share in South Australia is exceptional, but yet only 10% in Victoria. How big is this sort of customer base for you in terms of your revenues? Is it material? And what is sort of the milestones and challenges you faced in growing that market share in Victoria, maybe other states?
Yeah, look, NCML was the original collections business that Credit Clear acquired, who were Adelaide based, and they've clearly had a effective, you know, ownership of the council market in that territory. This time last year we had 0 councils in Victoria, so the fact that we've been able to grow it to 10% and our outlook moving forward is looking very positive. There is in each state different regulations around council collections. So there is some challenges, but they all lend themselves, all those changes in legislation all lend themselves to a very, very proactive digital workflow. And if we think about what our outlook moving forward, one of the biggest segments that we're budgeting growth in our software as a service is within that council space. So, you know, rates collection through non-traditional methods, which is sending letters out every quarter, to sending a digital message or a digital email or a text message is something that lots and lots of councils are very excited about from an innovation point of view, from a driving down the cost point of view, from actually avoiding taking litigation against their constituents. So traditionally, council collections have been heavily weighted towards legal. We're trying to disrupt that and make it more digitally focused and, you know, charging fee for service or licensing agreements. So a really key sector for us, and one that, you know, a couple of our sales guys have a great experience in selling to.
Fantastic. And is it, you mentioned there's one other competitor in the space. Is it really a duopoly situation, or is it very competitive?
There's lots of competitors that do council collections, but most of them are legal firms. So they are about sending a letter and then taking legal action after a quarterly notice has been sent. So we are very different in terms of our approach to how we do council collections, where we're using a digitally led process, where we're trying to resolve a council and avoid the need to go legal. So
fantastic.
Lots of legal providers that do work for councils, some collections businesses, and then there's a couple of, you know, fintechs that have a digital solution as well. So, you know, I think it's recognized as a pretty major sector in terms of credit and collections.
That's really good. can I just ask one other question? Victor or Andrew, maybe best place to answer. Costs for FY25. What are you guys thinking about in terms of cost expansion, given the business that you've got on your plate?
Yeah, look, I think I've said consistently, we focus heavily on gross profit margins here, where for FY23 last year, that was running at about 51%. This year is looking closer to 53, 54%. So again, achieving those improvements through digital collections, economies of scale, and we'll make use of our office in the Philippines as well. Although I want to make absolutely clear, Philippines will be used for back office, admin, client reporting, more so than direct communications with Australian-based clients. So with that, if you keep that in mind, we've budgeted an increase in revenue, which we can't disclose at the moment. We expect to see 54 to 55% of that flow through, but we'll set aside, let's say, 10% for increase in overheads. Notwithstanding that, we're comfortable with the senior management team. We don't expect to add to that over the next 12 months. Next largest cost is office rent. We've got capacity in Sydney, Melbourne, so we're good there. Tech hosting, that'll improve marginally. So to answer your question, marginal increase in overheads, keeping in mind that gross profit margin, we would expect to see 40% of incremental revenue flow through to underlying EBITDA.
Yep. Okay, that's fantastic.
All better.
Okay. Andrew, Victor, Jason, fantastic result. Thanks, guys.
Thanks a lot for your support.
Thank you.
Thanks, Larry. Caleb, some questions from you?
Yep, thanks, Warwick. Hey, guys, congrats on the great quarter and the record results. Just on ANZ, so you guys are basically have finished your onboarding process.
Yeah.
So now it's about, I guess, growing that portfolio of work there. Do you expect it to be, I guess, that growth, is that going to be linear, or is that going to be first half, second half weighted?
It's certainly going to be, gradual as it grows, but we've gone from having a small piece of one portfolio to having a larger piece of 3 portfolios. So, we do expect it, at least, by 2025 to be shaping up as a tier 1 client, if not 2026. So, it's certainly a client that would actually fit in that category for sure. How quickly can we get it there? In some respects, will determine exactly how much work they give us after the next 3-month review, if we can continue the performance levels.
All right, thanks. On the financial hardship product, is that going to be, are you guys planning to monetize that, or is that going to be a complementary product to help you guys win share work and win tenders?
Oh, look, it's definitely going to be monetized. This is certainly something. We did a project for a major energy retailer where we were charging to do this job manually at something like $150,000 a month. Now, we don't do that work anymore. So internally, people are spending millions and millions and millions of dollars to handle thousands and thousands of customers that can no longer afford to pay their bill when it falls due. So, in terms of a business case, to provide a software solution that can do it at a fraction of the cost is something that I see and have been told from clients that they're very interested once they can integrate that technology within their current CRM system. So it comes down to how we can integrate first. Monetizing it, I don't think will be a problem. It's more about how we deploy it technically.
Yep, for sure.
Yeah.
Thanks.
Caleb, just further to that, what gets lost a little bit in this slide is the end result is not only to treat, the debtor sympathetically, but it is to increase the likelihood of a collection being made, okay? Remembering our clients not only want to make that collection, but they want to retain that client. And what we've seen through this product is the great majority of people that owe money here is that they have intentions of paying. They just need time. So we're providing the tool here, okay, to allow them to make that payment. So remembering most of our revenue is based on collections. It's commission based. So that's where we monetize it, okay? It's something the regulators like. It's something our clients want. And there is a commercial aspect as well.
Yeah.
Yep, for sure. All right. Thank you guys so much. That's all from me.
Thanks very much, Caleb. We might go to a question that was submitted from Scott. How quickly can you onboard a client, and is the portal self-service for tier 3 clients?
Maybe.
I'm going to get James to answer that one.
Yeah. So in terms of how quickly, we always say to our clients, you won't be waiting for us. So it really depends on, how sophisticated they want to make the integration. But a very simple integration with them can be in a couple of days. That's what we told them. In a couple of days, we can have you up and running. But it does depend if they want to go to a sophisticated API-based integration, which we love them to do because they become very, very sticky. Then, a lot of that work is then us working with their tech team to get that done, and that will take longer than that. But a nice, simple client will get up and running in a couple of days. The portal self-service for tier 3 clients, portal self-service for everybody. And I guess there's two aspects of self-service. One is to the end customer, the debtor themselves. They can come in and manage their debt, make a payment, set up a payment plan. We recently released a bunch of new features to allow customers to adjust those plans and change payment methods. Lots of flexibility for them to do that, so they don't have to call in, which improves service and obviously improves profitability as well. And then self-service from the point of view of the client themselves, they can come into our SaaS platform and they can actually manage and configure the digital payments and workflows and templates, etc. themselves as well. But we usually provide that as a full service because we're the experts in the space.
Thanks very much. Perhaps one last question from Michael. Is Credit Clear looking at working with government?
Look, we work heavily with government across local and state government organisations. At the moment, we don't have any federal clients, like Centrelink or HO. They still represent probably the largest opportunities for us in this sector. Being that there's in excess of $50 billion of tax debt owed. So any piece of that we can help and assist with, it'd be a huge opportunity for us. At the moment, we're expanding our work that we're doing in the local government space. We're doing more work with state agencies, whether it be TAFE New South Wales, other learning organisations, Revenue New South Wales and other revenue departments remain very critical prospects for us. So, if we think about the pipeline or the size and volume of customers that we still have yet to even break into, it makes our outlook even more positive. I've been asked a few times, when do you think our growth's going to start to sort of plateau out? It's certainly not in the foreseeable future. So I still could see us to continue to accelerate growth over the next couple of years and sort of reach some of those big targets that we've got in terms of revenue of in excess of $100 million and earnings or underlying EBITDA of in excess of $25 million. So that's what we're looking to achieve, not just in terms of Australia, but in terms of internationally as well. So watch this space again for some exciting announcements in the next month or so.
Thanks, Andrew. I think we'll leave it there. We've answered all the questions that have come through. Like I said, a recording will be sent around later today, so keep an eye open for that. And maybe just a few concluding words, Andrew.
A little bit like the start of the meeting. We are incredibly proud, not just in terms of the last quarter result, but in terms of the last 2-year performance. We've really had to turn the business around, create strong discipline around cost management, maintained investment in technology to ensure that we are continually improving our moat and our AI and the things that make us attractive from an innovation point of view, but at the same time accelerated in terms of organic growth as well. So I think that having spoken to many of you over the past 2 years, and telling you that, we're going to achieve these results, to sit back and look at what we've achieved in the last, quarter, 12 months, 24 months. We're incredibly proud, not just in terms of what we've delivered, but in terms of where we're positioned in the market to deliver in the future. So thanks for those who have remained vigilant, held onto their shares, despite the fact our share price hasn't reflected the performance of the business. I think that we're starting to enter a phase where the promises that we're making, people can expect us to achieve them.
Thanks very much, everybody. Have a good day. Bye.
Right.
Thank you.